If you want to kickstart the dividend snowball effect, then you have to make sure you are buying stocks that are constantly increasing the amount they pay out in dividends, and this is the exact strategy I use for my personal portfolio that is already paying me over $5,000 every single year in dividend income. So in this video, let's look at 4 different dividend stocks that just recently announced dividend increases. So let's go ahead and dig in. Now, the first dividend stock we're going to look at that just announced a dividend increase is a company called Chubb Limited. It's a company that just increased their dividend by around 6%. Now, this company's actually been in the news quite a bit lately, and let me tell you why. It was recently announced Warren Buffett's Berkshire Hathaway took a position in this company. And if we jump over to dataroma.com, we can see a list of Warren Buffett's portfolio right here, and we can see Chubb Limited listed right here. It's now Warren Buffett's 9th largest position, making up around 2% of his entire portfolio. If we look at this company over the past year on Seeking Alpha, we can see they're up around 36%, and if we look at just the past month alone, after it was announced Warren Buffett took a position, it took a pretty big jump up, and it's up around 7% in the past month alone. Now, what does this company look like from a dividend perspective? If we jump over to my dividend breakdown spreadsheet, which by the way, you can download on tickerdata.com and also get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet. But if we come over here, we can plug in CB and hit enter. And you can see all this data is going to automatically load in thanks to the help of the Ticker Data add-on. Now, the first thing we'll notice if we come down here, we can see the starting yield for this company sitting at about 1.38%. Now, something else that jumps out to me, if we come over here and look at the free cash flow, we can see free cash flow for this company has been growing at a very rapid rate. If we look at the free cash flow versus dividends paid out, these blue bars represent our free cash flow and the red bars represent the dividends paid out. Now, we can see the dividends being paid out by the company is actually increasing on a yearly basis, which is something I like to see as a dividend growth investor, but the free cash flow is growing at an even higher rate. So what's the end result of this? Well, this is a very good thing because we can see the free cash flow payout ratio over time, because free cash flow is growing at a higher rate than dividends, is actually decreasing. We can see in 2017, it looks like they were using around 29% of their free cash flow to pay out dividends, but as of 2023, this got all the way down to 10%. So that means this company's only having to use 10% of their free cash flow to pay out dividends. That still leaves around 90% of their free cash flow to do things like reinvest back into the business or buy back shares or even pay down debt. Now, over the past 5 years, the dividend growth hasn't been anything too crazy. It's a little bit above 4%, but like we just saw a moment ago, it looks like their most recent dividend increase was around 6%. So maybe because their free cash flow payout ratio is so low, they'll start focusing a little bit more on dividend growth moving forward. Now, the next company we're going to look at is actually a company that is a dividend king, meaning they've been increasing dividend payments for over 50 consecutive years. Now, a lot of the times when we look at dividend king stocks, and this is something I've talked about recently, a lot of these companies aren't necessarily great dividend stocks anymore because they lack the potential for dividend growth and typically also have low starting dividend yields, which isn't necessarily a great combination. But this company is definitely an exception, and that is Parker Hannifin. We can see they just recently increased their dividend payout by 10.1%. That is a very big dividend increase, especially for a company that is a dividend king. Now, if we look at the company over the past year, we can see they have done extraordinarily well. They're up around 64%. If we look at them year to date, up almost 15%, and over the past month, actually down around 4.2%. If we go ahead and look at the dividend metrics for this company, we'll jump over to my dividend breakdown sheet, come up here, plug in stock ticker PH and hit enter, and the data will load in thanks to Ticker Data. Now again, this is a lower starting dividend yield company sitting at about 1.23%. So when we see a company with lower starting dividend yield, what we want to make sure they have is high levels of dividend growth, because a combination of low dividend yield and low dividend growth isn't really something we want to see. But if we come over here, we can see the dividend payments have been exploding from this company. The 10-year dividend CAGR sitting at 12.16%, and the 5-year dividend CAGR sitting at 13.91%. So despite the fact this company has been increasing dividend payments for over 50 consecutive years, they are still able to rapidly increase those dividend payments. I mean, look at it. It's gone in 2013 from around $1.78 now all the way up to $5.77 in 2023, and 2024 is now projected to be at $6.52. So that is rapid dividend growth during that time period. But if we look at the free cash flow payout ratio over time, we can see it's pretty much stayed below 30% for the entirety of this period because free cash flow has been growing at a high rate as well. If you want to see sustainable levels of dividend growth, then free cash flow has to be growing as well. Otherwise, we're going to see the free cash flow payout ratio climb higher and higher over time, making dividend growth unsustainable. And this is really charted out with our free cash flow versus dividends paid out chart. Again, you can see that red bar chart, those dividend payments are increasing. The total amount the company paid out in 2013 was around $255 $725 million, and if you look in 2023, they're paying out over $704 million. Well, we can see free cash flow has grown during that time period rapidly as well, going from $925 million all the way up to now around $2.6 billion. So not only are the dividend payments rapidly growing, but they are very sustainable, and the dividend growth is sustainable. Our next company also saw a pretty big dividend increase, and that was Ralph Lauren, and they announced around a 10% dividend hike, so another double-digit dividend hike from this company. We jump over to Seeking Alpha, we can see over the past year have performed extremely well, up around 67%. If we look at them year to date, up over 25%, and over the past month, they're actually up around 8%, with a nice spike up over just the past few days. If we go ahead and jump over to the dividend breakdown sheet, we'll come up here, plug in RL, and hit enter. And there's a couple of different things I want to point out. First off, we're looking at a company with a starting dividend yield sitting at about 1.83%. Now, that's a decent starting dividend yield, but at that dividend yield, we still want to see very high levels of dividend growth. Now, like we just mentioned, the past dividend increase was very nice, sitting at about 10%. But is that sustainable moving forward? Well, first off, if we come down here and look at the yearly dividends chart, we can see there's quite a bit of variability in the amount they're paying out in dividends. And it looks like in 2020, they had a pretty big dividend cut, or they paused their dividend payments during 2020. As for me, I want to see consistent dividend growth over long periods of time, so this isn't something that I like to see. If we come over here and look at the 10-year dividend CAGR, it's pretty decent at about 6.25%, but it looks like the 5-year is a little bit lower at about 4.19%. But then here's where I start to have the big problem. If we come over here, look at the free cash flow payout ratio for the trailing 12 months, sitting at about 102.5%. And that's because if we come down here and look at 2023, we can see they paid out around $198 million in dividend payments, but free cash flow was sitting at about $193.5 million. So this means the company's free cash flow did not cover their dividend payments in 2023. That is not a good sign. And if we look at the free cash flow payout ratio over time, we can see the higher free cash flow payout ratio is starting to become more and more common. For a while there, it was only sitting at around 25 or 30%. But ever since 2020, that free cash flow payout ratio has been climbing higher and higher, and again in 2023, 102%, not a good sign. So for me, as a dividend growth investor, for companies to sustainably grow their dividend payments over time, I need to see free cash flow growth over time. And if we look at the free cash flow versus dividends paid out chart overall, we can see in 2013, they generated around $742 million in free cash flow. 2014, $517, in 2015, around $503. But if we look at the past 3 years for this company, 2021 was sitting at about $273 million, 22, around $549 million, in 2023, $193 million. So the past 3 years of free cash flow have been significantly lower than they have been over the past decade. That's a pretty big concern for me, and it's one of the reasons I don't feel comfortable buying this company. Not to mention, if we jump over to my stock screener spreadsheet, look at the debt to assets ratio. We can see it's climbed quite a bit higher ever since 2020, and it hasn't gone down any either. And if we look at return on invested capital, it's just a little bit on the lower end for my liking. We can see it was decent for a while in around 2013 and 2014, but over the past few years, it's gone all the way down to around 10.75% and 10%, which isn't terrible, but typically I'd like to see it a little bit higher. And then finally, we have a favorite among dividend investors and dividend growth investors, and that is Realty Income, stock ticker O. They just announced they are increasing their monthly dividend by around 2.1%. Now, we need to put this into context. The 2.1% dividend increase doesn't necessarily mean it is the dividend hike over the next year, because this company actually increases the amount they pay out in dividends every single quarter. So let's go ahead and jump over to Seeking Alpha for reference. Now, first off, I do want to point out, REITs have struggled quite a bit over the past year and over the past few years in reality, ever since 2020. We can see over the past year, Realty Income down around 11.3%, and year to date, down around 8.72%. Now, if we jump over to the dividend history for this company, like I was just stating, they increase dividends every single quarter, and they also pay out dividends on a monthly basis. So you can see those dividends are being paid out every single month, and they're also increasing every single quarter. Now, the dividend hikes are small on a quarterly basis, but year over year, they're closer to around 3%. So if we jump up here and click on dividend growth for this company and scroll down, we can see the 3-year dividend CAGR for this company sitting at 4.15%, the 5-year around 3.55, and the 10-year sitting at 3.81. So now if we go ahead and jump over to our dividend breakdown sheet, the only thing I really want to point out for Realty Income, since we're talking about a REIT, isn't necessarily free cash flow metrics, but I want to point out the dividend yield. It's very nice, sitting at about 5.88%, but the payout ratio is showing 242.09%. Now, what's the reason behind this? Does this mean Realty Income does not have safe dividend payments? Well, we have to remember, Realty Income is a real estate investment trust. So what does that mean? Well, we don't want to pay attention to the payout ratio. What we want to pay attention to is the AFFO payout ratio. Dividends for REITs are paid out of the adjusted funds from operation, so that is the metric that we want to pay attention to. So if we click on dividend safety down here and start to scroll down, we can see AFFO payout ratio for Realty Income right here, showing around 74.62%, meaning these dividend payments are safe and are sustainable, and the dividend growth is sustainable as well. Now, something I do want to point out, if we jump over to my stock screener spreadsheet, you can see I've already plugged in stock ticker O. If we come over here and look at shares outstanding, we can see it's been increasing pretty dramatically over the past decade, and this is something I've talked about with Realty Income before. Now, increasing shares outstanding is actually pretty common for real estate investment trusts, but if we look at the past couple of years, we can see they have drastically increased the amount of shares outstanding that the company has. Now, why is this? Well, we have to keep in mind REITs have to pay out 90% of their earnings in the form of dividends, so it's pretty hard to reinvest back into the business. So really they have two options. They can either take out debt or issue new shares, and with interest rates as high as they are right now, it looks like the company is electing to issue new shares outstanding as of right now, as they believe that is the best way for the company to grow. So is increasing shares outstanding a great thing? Well, it really depends. Usually we don't want to see this as shareholders, but if the company's able to grow at a healthy rate from issuing new shares, then it may make sense. But overall, this is definitely something to keep your eye on. So there you go. Those are 4 dividend stocks that just recently announced dividend increases. Go ahead and let me know what you think of these companies in the comments down below. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.